Hello everyone. Today we'll be looking at double entry system for asset of stock. First, what is stock? So this represents items acquired for the business for the purpose of sales. So in other words, it is items bought for the purpose of resale. The stock account is divided into 4 accounts. So we have the purchases account, the sales account, the return outwards account, and the return inwards account. The inventory of goods in a business constantly changes because some of it is bought, some of it is sold, some of it is returned to suppliers, and some of it is returned by the firm's customers. To keep a check on the movement of inventory, various accounts are opened as shown in the table below. So the purchases account is used to record the purchase of goods. The return inwards or the sales return account is used to record goods returned to the firm by its customers or debtors. The sales account is used to record the sale of goods, and the return outwards or the purchases return account is used to record goods returned by the firm to its suppliers or creditors. Alright, so now we're going to record these transactions using the double entry system for asset of stock. So in the year 2018, on May 1, bought goods on credit $680 from D Small. So the two accounts being affected in this transaction would be the stock account. So there's an increase in stock or there's an increase in inventory. So inventory is another word for stock. So there's an increase in inventory and we need to say the type of movement in order to determine the stock account being affected. So right here, we see that goods are being bought. So we would make reference to the purchases account, which is used to record the purchase of goods in the organization or in the firm. So the first account being affected in this transaction would be purchases and D Small. So all transactions must be read at or must be looked at from the business point of view. So it is the business who bought goods on credit from D Small. So D Small would be a supplier or a creditor to the business. So the purchases account, it is always debited to show an increase in inventory. And then the creditor account, which would be D Small, would be credited to show an increase in liability as the firm now owes D Small. So we need to debit the purchases account and credit D Small's account. So we come to the debit side of the purchases account and we record the date. So that's May 1. The details would be the name of the other account in the very same transaction that is being affected. So hence we would have D Small and the amount, which is $680. So now we need to go down to D Small's account and record that very same transaction in D Small's account. So again, we record the date. It is May 1. In the detail, we'd have the name of the other account in the same transaction that is being affected. So in this case, it would be purchases and the amount of $680. On May 2, bought goods on credit $770 from A. Leon and Son. So again, the purchases account is being affected right here because goods are being purchased And also A. Linon and Son would be the other account affected in that transaction, as the business took goods on credit from A. Linon and Son. So again, we're going to debit the purchases account as at May 2 to show that there's an increase in goods in the business. So we don't need to construct any more purchases account. We're going to use the same one. So May 2, in the detail, we will have A. Linon and Son. And the amount, $770. To show that the business owes A. Linon and Son for these goods. So May 2, in the detail, we would have purchases and the amount of $770. So on May 5, sold goods on credit to D Block for $600. So right here, the sales account would be affected because goods are being sold. So the sales account is affected right here. And also D Block account is also affected. So the business sold goods on credit to D Block for $600. So the sales account, it is always credited to show a decrease or a reduction in stock. So goods is leaving the firm and going to our customers or our debtors. So we need to credit the sales account to show a decrease in stock. And then we need to debit D Block's account because D Block is a debtor. And D Block now owes the business for these goods which he took on credit. So we're going to go down to our sales account and make a credit entry. So we come to the right hand side. It's the credit side for our sales account. And it is May 5. In the detail, we would have D Block and the amount of $600. And then we need to go to D Block's account and make a debit entry to show that this customer now owes the business for the goods that he took on credit. So May 5, made a sale of $600. On May 6, sold goods on credit to M. Spencer for $450. So again, the sales account is being affected because goods is being sold to another customer or another debtor. So the sales account should be credited to show that goods is coming out of the business. And M. Spencer is a customer or a debtor or an account receivable. So this person accounts need to be debited to show that he or she now owes the business for the goods that he took on credit. So again, we're going to go to our sales account and we're going to make a credit entry. So May 6. Spencer should be in the detail. And the amount is $450. And then we need to go down to M. Spencer's account and record that same transaction. So May 6. In the detail, we would have sales and the amount of $450. On May 10, return goods $150 to D Small. So on May 10, the business returned goods amounting to $150 to D Small. So goods is leaving the business and going back to our supplier. So in that case, return outwards account would be affected, seeing that it is a firm or the business that is returning the goods to the supplier. So the return outwards account is affected, as well as the creditor, who is D Small, or the supplier, who is D Small. So the return outwards account, it is always credited to show that goods is leaving the firm or leaving the business. So goods is coming out of the business. So hence the return outwards account is always credited to show a reduction in stock. And then we will need to debit D Small's account to show that the business now owes this person less, because he's returning, or the business is returning the goods that they took. So they no longer, or they owe this person less. Sorry. So we go down to the return outwards account and we're going to make a credit entry. So on May 10, D Small and the amount of $150. And then we need to go to D Small's account and we need to make a debit entry to show a reduction in the firm's or in the business liability. So on May 10, return outwards, $150. On May 12, goods bought for cash, $1,000. So the two accounts affected right here would be purchases, seeing that it is goods bought. So this is a purchase being made. So the stock account is being affected as a result of the movement of a purchase being made. So hence the purchases account. And then the cash account is also affected because cash was taken out of the business in order to purchase these goods. So again, purchases account, it is always debited to show an increase in stock. So we're going to go to the purchases account and we're going to make a debit entry. And then seeing that goods bought for cash, so we use cash to pay for these goods. So cash is an asset and cash is going down. When asset decreases, we credit. So we're going to make a debit entry in the purchases account and a credit entry in the cash account. And then we go down to the cash account. Then on May 19, M. Spencer returned $160 of goods to us. So here a customer is returning goods valued at $160 to the firm. So that's return inwards because the customer is bringing it back to the firm. So right here, this would be return inwards. And the other account or the other item affected in that transaction would be M. Spencer. So the customer as well as return inwards. So as was mentioned earlier, the return inwards account, it is always debited to show an increase in stock because goods is coming back to the firm. And then we now need to credit M. Spencer because M. Spencer is a customer or a debtor. So it's an asset to the business. So we need to credit M. Spencer's account to show that the goods were returned to the firm. So we need to take it out of M. Spencer's account. On May 21, goods sold for cash $1,500. So here the stock account is being affected, and in order to determine which of the stock account, we need to know which movement would have occurred in the inventory or in the stock. And it clearly states that it is goods sold. So it is the sales account. And then the other item affected would be cash. So the sales account is always credited to show that goods is coming out of the business. And then the cash account would be debited to show that money is being received as a result of the sale that was made. So we're going to credit the sales account and debit the cash account. On May 22, paid cash to D Small $530. So the business paid cash to D Small $530. So realize in the first transaction, the business would have bought goods on credit $680 from D Small, and now at May 22, the business is paying D Small $530. So the two items being affected would be cash and D Small. So cash is an asset, and asset is decreasing as a result of it being used to pay the business creditor. So we need to credit our cash account to show that money is taken out in order to repay D Small or creditor. And then we need to debit D Small's account to show that the business now owes D Small less, seeing that the business would have taken goods from D Small valued at $680, but they made a payment on May 22 of $530. So we're going to credit cash and debit D small. So on May 30, D Black paid the amount owing by him $600 in cash. So here a customer repaid the business the amount that he or she would have owed the business in cash. So the customer's account would be affected. His account would be going down. So we need to credit the Black account. And he paid the amount owing by him $600 in cash. So cash is an asset and cash is coming in. So that's an increase in asset. And as asset increases, we debit. So we are going to debit the cash account and credit the Black's account. The final transaction on May 31st bought goods on credit $640 from A. Lennon and Son. So the business bought goods on credit from A. Lennon and Son. So here, the stock account or the goods account or the inventory account is being affected. And this is as a result of a purchase movement that would have taken place, because it says that the business bought goods on credit. So here, purchases account would be affected, and the supplier or the creditor, which would be A. Lennon and Son, would also be affected. So remember, we would have said earlier, the purchases account is always debited to show an increase in stock. Because if the business bought goods, you know that's more goods or more stock coming into the business. So the purchases account is always debited to show an increase in stock. And we need to credit A. Lennon and Son to show that the business owes for these goods. So A. Lennon and Son is a liability account because they are the creditor. They are the business's creditor. So we're going to debit purchases and credit A. Lennon and Son. Carried all these transactions using the double entry system for a set of stock, we are going to double check to ensure that we would have correctly placed all these entries. So the purchases account, on May 1, we bought goods on credit $680 from D Small. So we have it right here. So this very same transaction should also be reflected in D Small's account. So let's hurry down to D Small just to double check. There we have it. On May 1, purchases of $680. Right along on May 2, bought goods on credit $770 from A. Lennon and Son. So here we have it. Under the purchases account, May 2, A. Lennon and Son, $770. We're gonna go down to A. Lennon and Son. and it should reflect that a purchase was made on May 2. So Alien and Son, purchases of $770 on May 2. On May 5, the business sold goods on credit to D Black for $600. So we're gonna go to our sales account to show that this was recorded. So see, on May 5, sold goods to D Black for $600. So now we need to go to D Black account to show that the sale was made. So D Black, that's D small, so D Black. So oops, we would have made an error right here. So we would have placed D Black's entry under D small. So we got confused with the D's right here. So this transaction on May 5 should have been in D Black account and not D small. So let's just move it to D Black's account. So now that entry is correctly placed. So May 5, we sold goods on credit to D Black for $600. And that is reflected right here. So on May 6, sold goods on credit to M. Spencer for $450. So let's go to the sales account to show that a sale was made to M. Spencer of $450. So here we have it. So let's check M. Spencer's account, Spencer, and here we have it. On May 6, sale of $450. On May 10, the business returned goods $150 to D Small. So let's check our return outwards and D Small account. So return outwards right here, May 10, D Small 150. So that's correctly placed. So let's check D Small's account. And there we have it. On May 10, business return goods valued at $150. So on May 12, goods bought for cash $1,000. Right here, under the purchases account, we show that goods were being bought for cash at $1,000. So now we need to go to the cash account to check to see if we would have recorded that purchase that was made. Here's our cash account, May 12, purchase of $1,000. So yes, that was correctly recorded. So now on May 19, M. Spencer returned $160 worth of goods to us. So we need to check our return inwards account. Turn inwards right here. So May 19, M. Spencer returned goods to the firm valued at $160. And then we need to check M. Spencer's account. And M. Spencer returned goods to the firm. Turn inwards, valued at $160. On May 21, goods sold for cash $1,500. So we need to check our sales account. And there we have it. May 21, goods sold for cash $1,500. So now we need to go to our cash account to show that cash would have come into the business as a result of the sale that was made on May 21 of $1,500. On May 22, we paid cash to D Small. So May 22, money was taken out of the business to repay the creditor D Small $530. So let's check D Small's account show a reduction in our liability. So D small. And there we have it. On May 22, cash was paid to D small of $530. So on May 30, we have where D Black paid the amount owing by him $600 in cash. Pay the amount owing by him in cash. So right here. So we would have credited our debtor or our customer's account to show that he would have made the payment to us in cash. And we would have debited our cash account to show that this customer, D Black, would have repaid us on May 30 amount of $600. And in the final transaction, which would have taken place on May 31, wherein the business bought goods on credit $640 from A. Lennon and Son. So we need to check A. Lennon and Son and purchases account. So right here, A. Lennon and Son, May 31, purchases $640. And let's check our purchases account. So there we have it, May 31, A. Lennon and Son, $640. So all the transactions were correctly placed. So whenever you're recording transactions using the double entry system, it is always a wise idea to double check when you are through, so that you do not misplace any of these entries. So in closing, here is an important point, or here are two important points to note when recording transactions using the double entry system for asset of stock. So the purchases and the return inwards accounts, they are always debited to show an increase in stock. On the other hand, the sales and the return outwards account, they are always credited to show a decrease in stock. So if you have any question, you can go ahead and leave it in the comment section below. Feel free to like, share, comment, and subscribe.